Hey everybody, welcome back to Two Guys Talking Houses. It's 2026. Happy New Year to you all. One thing that a lot of people are talking about as we come into the new year is affordability. Are houses going to get more affordable this year? And so, Mark, I think that's a great first topic, right? And the old adage, growing up and hearing my parents talk about it was that you shouldn't buy a house more than 3 times your annual income. Well, obviously, we know right now when you look at the average income and you look at the average house price, something's gone awry.
Definitely something's gone awry. And it's definitely changed over the years. Conventional wisdom, first of all, people can qualify for more house than they could back in the, say 70s, 80s, and debt to income ratios are allowed to go higher. There's certainly that. But what's happened more recently is we've seen surges in the market. You think COVID.
It was certainly a surge, yeah.
What I mean, it was crazy, and people were buying houses left and right. There were people lined up 10 and 15 deep to make an offer on a house, and I mean, if you didn't offer at least asking price plus 20 grand, you weren't even in the running.
Yeah.
And what happened is the rates were great, right? They were super artificially low. Notice I threw in that artificially low part.
Yep.
But anyway, they were super low, and so everybody was buying a house, and all these people were listing their house because they can buy a house for cheap, right? And they were affordable by those means. Now, then the prices went up because as you continue to pay $20,000 and $30,000 over the asking price, the average price, the sales in the neighborhood,
The comps
go
change,
up.
yeah.
The values go up, and then now the prices go up. And, at some point that should probably break, you know? And it's funny, people, I mean, have you heard anybody complain about the tax value?
Yeah, no, all the time here in Texas. So it's funny. I've got a listing right now in Seabrook, and their appraised value, according to Harris County, is I think $505,000. Take a guess at what this house is listed at.
$1 million?
No. $399,000,
Oh my gosh.
and we were lucky if we get a showing a week. So
Oh,
the
wow.
tax appraisal values that would, in some cases, people will protest the taxes and they're
Yeah.
successful, and then they come down in value and then they pay less in property tax. In this
Oh my
case, my
gosh.
poor clients, they get a $500,000 valuation. I showed all the comps necessary to protest this, and the county wasn't hearing it. So
That's crazy.
it's really a bizarre time. And, when you talk about COVID, right?
Yeah.
And, what happened during COVID, yes, the home prices shot through the roof, but the cheap money was there. People were borrowing at 2% interest. So what do people really care about more than the price of the house? How much down, how much a month, right?
How much I got to pay?
How much I got to pay
Yeah.
before they throw me out of this thing?
It's like buying a car.
Exactly.
What do I got to pay a month? What do I got to put down?
That's right. And so what happened was, in my opinion, at least from a realtor's perspective, be interested to hear your thoughts. But, so yeah, okay, you buy a house that was $350,000 last year. All of a sudden it's $445,000, but you got a 2% interest rate. So your mortgage rate is still within, your mortgage payment rather is still within the normal, what would be a budget-friendly sort of payment.
Right.
And then what happened after COVID? The Fed tightens like crazy, rates shoot up through the roof. So what do you think happens? Well, generally in that scenario, home prices come down, but we still had the inventory shortage. So it's like now that house is 445, maybe it went down to 437, but it's still like in the same ballpark. But instead of a 2% interest rate, now we have, what were some of those beauties that you told me? 8, 7.5,
Yeah, I mean, some of them were 7.5%, 8%. And I mean, these are people with good credit.
Yeah.
I mean, I've got a buddy who's a car dealer, and he's telling me that people with 800 credit scores are paying like 9% on their car loan. I'm like, what are you talking about? This is back in 22 when things started to really go nuts on rates. And we can talk all day about why that happened, and what caused rates to go up, or what was the inspiration for the Federal Reserve saying, whoa, we got to change things quick.
Yeah.
Right. But the reality is that, rates shot up in a hurry, and all of a sudden, people that were trying to sell their houses couldn't.
Yeah.
And so the market slowed down. Wages still have gone up over time. It's the average median income, which might have been like $70,000 or $80,000 back then. The last number I saw was like 105.
Right.
And so now, during COVID, if you take, your old 3 times your income, what do you think that ended up being during COVID? I mean, how many times your income did you have to spend?
Yeah, definitely not 3. Probably
No.
4.5, 5 would be my guess.
Yeah, 5. It was about five times your annual income to be able to, to afford a house. So that was the median price of a home and median income at the time. And it was just kind of crazy, you know. Now, when the value of the house goes up, and here in Texas, I don't know how they do it in every other state because I don't live there. But here in Texas, you've got a couple things at play. You've got a homestead exemption, which limits the increase in value, taxable value, to 10% a year.
Yeah.
But if that maximum is reached, that goes into a bucket of homestead loss, as they call it. And so it's the difference between what your actual market value went up and how much they can raise your taxable value, that 10% limit.
Yeah.
And so that pretty much guarantees every single year your taxes are going up because the market rate went up faster than that 10% limit. And so now if you buy that house, then the market value will reset at whatever the market value is.
Yeah.
The taxable value will reset at whatever the market value is or close. And so, that's how you get a house that was taxed at 200 and you buy it for 500. Now it's taxed to 500 or 480 or whatever. Yeah. And so that certainly has increased and affected the affordability. And it's funny, we didn't talk about affordability. Well, you and I talked about affordability.
Yeah.
But it's like in the last 6 months or so, all of a sudden everybody else has woken up about this thing. Like, oh my gosh, people can afford their house payments.
Right.
Yeah, no kidding. But it's interest rates were part of it, but we're back down to 6%. We're not at 8 anymore. So that argument doesn't hold as much water. What's happened is insurance has skyrocketed.
That's another
doubled,
big problem.
Tripled in some areas. It's gotten ridiculous. And then the taxes, the funny thing, people complain, oh, my tax value went up, so much. Well, did the actual value of the house go up? Because that's sort of what you're supposed to be taxed on anyway.
Right.
Oh, yeah, my value went up $200,000 in the last 3 years. Oh, well, yeah, of course your taxes are going to go up because the actual value of your house did go up indeed. So, you can't have it both ways. Like, oh, my house is worth 500 and they're only taxed at 300. Like eventually that catches up.
Yeah.
And so really what's happened is kind of a combination of factors of insurance, taxes, interest rate. And then rates came down from, 8 to 6, which made a huge difference. But you still have the taxes and the insurance as an issue. Now,
yeah, and that's the big thing, that the insurance, especially we're here in coastal Texas, and that may be the house that I mentioned in the beginning of the episode, that's appraised at 500, the tax district thinks it's worth 500. It may be worth close to somewhere in the 500 range, but we can't move it at that price because the insurance costs are so onerous that nobody wants to pay that market value for the house. So it's a tough thing, so I'm just going back and kind of doing some math in my head. We talk about that 3 times your income should be the max you buy for a house. We know that we're not living in an environment where that is a reality.
Right.
And so, what's the average home price? I think across the country, somewhere like 480. Is that right?
Yeah.
So we're looking at 480 throughout the country. Average income, as you just said, is 105.
Yeah.
But the other thing you have to factor in is, like, I assume that average income is including dual income families.
Yeah.
So, that's 2 people making 50 grand.
Yeah, we have to say household income.
Right.
Because the average income of an individual is quite different.
Right.
But if you have 2 people and they're making roughly 50 something a year, then that makes sense, and it's mostly double income. And some families do it a little differently too. Maybe there's 3 people contributing to that. Maybe one of the kids is working and, that's counted in there somehow. Point is that, it's still, if you do the math, it's not 3 times anymore. It's not 5 times anymore. It's
4.5, basically.
about 4.5. Yeah.
And then
it's coming down.
And so that's a good thing. My main concerns for those sorts of statistics are, one, because I speak to a lot of just single guys, for example, 27, 28 years old, just out of college, maybe they got a little bit of student loan debt, decent credit score. They've just gotten themselves a decent job, but they're not married yet. They don't have a partner that's contributing that other half.
Right.
They're making $65,000 a year. Even if you multiply that by 4, let's say 4.5, 6 times 4 is 240,000. So 4.5, you're looking somewhere in the mid to high 200s.
Yeah.
You're kind of hard pressed to find homes, and you can find them here in Texas, which is unusual. I mean, people were 30 minutes away from the bustling downtown metropolis of Houston. The fact that you can still buy a home in the 200s within a 45-minute drive of Houston, which you can, is kind of an anomaly, because most big cities you cannot get anywhere in that range. So that, and then when you do have the double income, dinks, as they call them, double income,
Right.
no kids,
Right.
they're easy money. They're all day long. They got maybe they got some student loan debt, but they both got good jobs. They got no child care, whatever. But what about that young family that's got daycare? And I've talked to a lot of people, know a lot of them that, one income is essentially set aside just to pay for daycare. Mm-hmm. So it's like yes, you do have 2 incomes, but in reality, you just kind of have one because one is spoken for. So
Yeah. We did that for a while.
Yeah. Yeah. It's what do you think is the solution / what are we going to see in 2026 that would give those types of situations that I just described, those buyers, because there's a lot of them out there, hope that maybe this is the year they can buy a home?
Well, and there's a couple things going on. I mean, I got to ask you a question. It's 2026. What do you think home prices will do? Are we going to see, are they flat? I mean, and there's really 2 quantifiers here. U.S. nationwide, and then, of course, where we are in Houston, which, of course, I mean, we believe is the greatest real estate market ever.
Yeah.
But, maybe everybody else doesn't believe that. But, hey, but it's a great market. What are we going to see in price appreciation in 26? It's going to be 20%?
No, and I do think Houston is one of the best markets there is, and I'm partial to it. Although I do have some friends in San Diego and Austin, and
yes.
I realtors. I wish I saw some of the commission checks that they see.
Sure,
but that's neither
cool.
here nor there. That would be cool.
Right.
But so I think that answer kind of lies in what happens with the Fed, what happens with who Trump puts in office, or not in office, who puts it in that position of federal chairman after Jerome Powell leaves in May. So is that person hawkish? Are they dovish? Do they want to get in there and slash? Does the 50-year mortgage become a real thing? And then, to add to that, is that a good thing? Because, it's great to, pay less per month. But I think we talked about this on another episode. 50 years, a $300,000 house, you're going to pay like $917,000 for that house. Yeah. When you look at all the payments, will it appreciate in 50 years more than 3x?
Yeah.
So there's a lot of things to consider there. My honest prediction right now, as of January 2026, is that we're going to see kind of a flat year, maybe even, and hold your breath, sellers, they're not going to want to hear this. Maybe we do see a 0.5% to 1.5% drop in overall prices, just depending on, what happens with interest rates and inventory and stuff like that. The builders are going to be incentivized. Bill Pulte has made that very clear. Build homes, create inventory. What does that do to the overall market? But I think the bigger story is going to be more localized to where you live, because, in Houston, I think we're going to kind of stay even Steven. But man, if you bought a mansion in downtown Austin during COVID, you might be taking a bath this year. And if you're a buyer for a house in downtown Austin, you might get a screaming deal. So I think 2026 is going to be the year of where we really see the localized markets matter far more than the national statistics.
Yeah, I think, and the research shows, I mean, the vast majority of the U.S., right now is kind of flat. Mm-hmm. You might see an increase of, anywhere from 1% to 5% at the very most.
Yeah.
It is those hotbed cities, Vegas, Arizona, Scottsdale, yes,
Miami,
and,
or basically where everybody moved during COVID. That's where they're hitting.
Exactly. I mean, those are seeing drastic decreases.
Yeah.
Which makes it easy for those YouTubers to make a video about, oh my gosh, the sky is falling, markets are crashing.
Yeah.
It's 2008 again. I mean, we did a video about that,
not that
quite a while,
long ago,
not that long ago, about why it's not going to crash. And I mean, it is kind of gratifying to see, hey, guess what? It didn't crash, at least here locally. And the places that are quote unquote crashing, I mean, I hate to say it, maybe they probably should have. I mean, those are the same ones that went up 20%.
Yeah.
Like what comes up must eventually come down, you would think. Yeah. But even in normal markets that increased normal during COVID, 15, 20%, whatever, they've settled and they've settled down, and the thing that's gotten out of control is cost of construction, cost of insurance as a result. Mm-hmm. The number of claims has increased.
Yeah.
And so insurance has become such a big problem. Even as rates come down, I mean, okay, we're at 6 on a conventional real estate mortgage right now. Let's say we get to 5.5. Okay, that's great, but we're only talking, $60, $70 a month on the average mortgage. We're not talking, $1 million here.
That's probably your family's Chick-fil-A run.
Yes, indeed. Well, I don't know, and it's not Chick-fil-A anymore. Now
where are you guys going now?
Now our kid, well, not together. We don't typically go, if it's just Jen and I, we'll go to Chick-fil-A.
Okay.
But our youngest is switched. He doesn't like Chick-fil-A anymore. He goes to Chicken Express.
Chicken Express, okay.
Yeah.
I pass by that every day, never been.
As a parent, I felt I should, try it and see what it's all about. I will continue to eat at Chick-fil-A. Nothing against Chicken Express, just not for me. So, but whatever.
So Chicken Express will not be reaching out to us with a sponsorship opportunity.
No, probably not.
Chick-fil-A, we're here. We're ready.
Chick-fil-A, I mean, I know a couple people own Chick-fil-A, so that would be a good idea. Maybe I should start hitting them up. But back to, I mean, we're not seeing, it's not going to come in interest rates. It's going to have to come in things like insurance.
Yeah.
The 50-year loan, oh my gosh. Go finance a car for 8 years or 9 years.
Yeah.
I mean, yes, that's a depreciating asset in theory, unless you buy, a vintage German sports car or something like that. Yeah. Then you're probably not going to see a drop. But point is that, I think, we are going to see more affordability, and it's coming by way of things like the increase in, the increase in value is settled. Yes, we'll see a little bit more relief, I think, in 26 on rates.
Yeah.
5 3/4, 5.5 maybe,
Yeah.
Do you know what the national average interest rate is right now on everybody who's got a mortgage?
Everybody who already has it. So
everybody's already got a mortgage right now.
Under 4%, I've heard.
The last number I heard was 4.4.
4.4. Okay.
That now there's as many people who have a 6% mortgage as there are that have a 3% mortgage.
Okay. And then I heard that there's quite a bit of people that, when you look at the overall market where their house is there is no mortgage on it.
Yeah, I mean, average equity is like 47% of the value of the house right now, which is great. And you know what? That was another effect of COVID. Your house goes up from $200,000 to $300,000 in value. You've got more equity now. Mm-hmm. Again, part of why we didn't see a crash. I mean, people weren't like, think about 2008. Like there were too many houses on the market.
Right.
Right. And then it was hard to buy. Well, we didn't have that problem.
Yeah.
Inventory stalled, there was not enough inventory and rates went up.
Yeah.
Still, but, point is that I think in 26 we'll see, we'll see a settling of that and more affordability. I think something has to be done about insurance.
Yeah. We probably should at some point, like either I step out of the chair or we put a third chair here, bring an insurance person onto the show to ask, what the heck can be done about this, because that's the one X factor, what I do and what you do is like, people are like, God, these insurance costs. And I'm like, God, no, I pay them too. They suck, come on, insurance, what can we do here to get that? Because that is, when you talk about overall affordability of housing, you can't have that conversation without bringing up the insurance premiums.
Yeah.
And so that's a major thing. And that's something that, we have zero control over.
Yeah. And we've talked about this before that, consulting somebody who is in the know, who knows what they're doing, on the real estate side, the mortgage side,
Yeah.
and has some knowledge of what, I had a conversation earlier today with an agent, and they have been under contract to buy this house, not the agent themselves, their buyer. Buyer's a little old lady, and she wants to buy her first house.
Yeah.
Right. Great story. Right. They have been at it since October 1st
Oh, man.
and still don't have a loan. And the norm, the heartbreaking thing. And the agent, I said, well, how much is the insurance? And she told me, and I was like, wow, that seems awfully cheap. How much is the deductible? So if you're not familiar with their insurance, the deductible is how much do you pay
Right.
before the insurance starts
If
paying,
something
right?
happens. Yep.
If something happens. And, 1%, 2%, that's kind of normal, right?
Yeah.
5%.
Okay.
So again, little old lady who's getting a down payment assistance program, which by the way, won't allow a 5% deductible.
Yeah.
But that's what an insurance quote says is 5% deductible. If something happens to that house, she's going to have to pay 15 grand.
Right. Yeah. And she's not going to have it.
Yeah. She doesn't have 10,000, you're 5,000 to put
Yeah.
down on the house, so, I mean, that's the wrong way to do it.
Yeah.
You don't want to get stuck in that. And I think, unfortunately people just, okay, that's what I got to do. That's what I'll do. And, if you're not paying attention, that can cause some problems. That's
Yeah.
not the way to make a house affordable.
Yeah, for sure. Yeah. That's kind of just getting, and we're talking, I don't know, I'm sure she's in this area if you're
Oh, yeah.
talking to her. So
Texas City,
coastal. Oh yeah. Even better. So coastal Texas,
coastal Texas.
it's not a matter of if we're going to get a hurricane come through here. It's a matter of when, and so that's part of the deal. It's just the unfortunate reality. So it's a really interesting conversation. I think we kind of touched on everything, but I do think we're going to start to see, because if home prices can just stay flat for a couple of years or even creep up a little bit, but incomes start to catch up to some degree,
Yeah.
then you're never going to get back to that 3-year, sort of three times more than your 1-year salary. But if you can get closer to 4 instead of closer to 5, I think it's going to be a lot more palatable for people to start buying homes and stop renting. Because quite frankly, I do talk to a lot of young people that when you do things the right way, they look at, okay, insurance is high, interest rates are high, okay, how do we go in and negotiate with the seller? Like maybe we don't knock them down huge on the sales price. Maybe we ask for a lot of seller credits that we then use to buy down the interest rate, put some money in your pocket, or just simply you have more money in your pocket at closing to where you feel more comfortable because you're only coming with the down payment and the seller's paying your closing costs. So, when you look at it from a holistic, like every client is different, every transaction is different. You have to look at it from, and I'm not telling you anything you don't know. You've been doing this longer than me. You have to look at it from, how can I serve this person to make their dream of purchasing a home a reality?
Right. And we should mention one last thing. And we haven't talked about property taxes. Texas is a unique place. We are fond of it because we live here.
Yeah.
But our legislature has actually helped bring down the taxes, tax rate. If you have a homestead exemption, it's your primary, residence. I think the school tax exemption, which basically whatever your value is minus this amount. So, went from like 40,000, now it's over 100,000.
Yeah.
And so that the actual tax rate, property tax rates have come down. It's just our biggest problem is insurance. And the rates have come down, obviously 2%, 8 to 6.
8 to 6,
hey, and FHA is below that. And we have had people buy it down to 4 or something, okay, well, that makes sense. You're never going to refinance if you're in the 4s.
Right.
So, but point is that, it's not the property taxes really that are causing the issue per se. The values have gone up, and, if you're at 2% of 200,000 and then your value goes to 300,000, yes, your taxes will go up. That's how that works.
Yep.
But it's certainly, it's the insurance for sure that's been causing a lot of problems.
I think that's the perfect place to leave it.
Yep.
Thanks so much for watching, everybody. We'll see you next time.